Dear viewers, I'm your host Muhammad Asif Jaja and you are watching YouTube channel ETV 786. This channel is created for business students. On this channel, we have delivered the basic concepts of accounting and business law and now starting the third study course, Business Taxes. Welcome to your own channel. Please watch, like, share and comment the videos and subscribe the channel to view upcoming shows. The following topics will be covered in Introduction to Business Taxes. Number 1, definition of taxes. Number 2, tax system. Number 3, importance, the study of tax. Number 4, why do we pay taxes? Number 5, what is taxpayer? Number 6, what is the tax rate? Number 7, what is taxable income? Number 8, what is adjusted gross income? Number 9, features of tax system. Number 10, progressive, regressive and proportional taxes. Number 11, lump sum taxes. Number 12, direct and indirect taxes. Number 13, fees and effectives. Number 14, inflation tax and financial repression. Number 15, income tax types. Number 16, capital gain tax. Number 17, payroll tax. Number 18, corporate tax. Number 19, sale tax. Number 20, property tax. Number 21, wealth tax. Number 22, tariffs. Number 23, inheritance tax. Number 24, expatriation tax. Number 25, transfer tax. Number 26, value added tax. Number 27, excises. Number 28, license fees. Number 29, poll tax. Number 30, descriptive labels. Number 31, consumption tax. And number 32, environmental tax. So let's start the show. Definition of tax. Taxes are mandatory contributions levied on individuals or corporations by a government entity, whether local, regional or national. Tax revenues finance government activities including public works and services such as roads and schools, or programs such as Social Security and Medicare. A failure to pay in a timely manner, along with evasion of or resistance to taxation, is punishable by law. Taxes consist of direct or indirect taxes and may be paid in money or as its labor equivalent. The first known taxation took place in ancient Egypt around 3000 or 2800 BC. Tax system. Most countries have a tax system in place in order to pay for public, common or agreed national needs and for the functions of government. Some levy a flat percentage rate of taxation on personal annual income, but most scale taxes are progressive based on brackets of annual income amount. In many countries in the world, income taxes are applied to some form of money received by the taxpayer. A money could be income earned from salary, rent, capital gains, dividends, or interest received as additional income, payments made for goods and services, and so on. How study of tax is important. Tax systems vary widely among nations, and it is important for individuals and corporations to carefully study a new locale's tax laws before earning income or doing business there. Generally speaking, the federal government levies income, corporate and payroll taxes. The state levies income and sale taxes, and municipalities or other local governments mainly levy property taxes to run and operate their systems. Why do we pay taxes? Taxes are the primary source of revenue for most governments. Among other things, this money is spent to improve and maintain public infrastructure, including the roads we travel on, and funds public services such as schools, emergency services, welfare programs, and to run the general affairs of the government. What is taxpayer? A taxpayer may be an individual or business entity that is obligated to pay taxes to a federal, state, or local government. Taxes from both individuals and businesses are a primary source of revenue for governments. In many countries, individual taxpayers are usually required to file and pay both federal and state tax returns annually. Businesses must also file annual returns but usually plan for and pay regular estimated tax payments throughout the year. What is tax rate? A tax rate is the percentage at which an individual or corporation is taxed. To help build and maintain the infrastructures used in a country, the government usually taxes its residents. Many countries use a progressive tax rate system in which the percentage of tax charged increases as the amount of the person's or entity's taxable income increases. What is taxable income? Taxable income is the portion of an individual's or a company's income used to calculate how much tax they owe to government in a given tax year. It can be described broadly as adjusted gross income minus allowable itemized or standard deductions. Taxable income includes wages, salaries, bonuses, and tips, as well as investment income and various types of unearned income. What is adjusted gross income? Adjusted gross income is the Internal Revenue Service (IRS) figure to determine your income tax liability for the year. It is calculated by subtracting certain adjustments from gross income, such as business expenses, student loan interest payments, and other expenses. After calculating AGI, the next step is to subtract deductions to determine the taxpayer's taxable income. Feature of tax systems. An important feature of tax systems is the percentage of the tax burden as it relates to income or consumption. The terms progressive, regressive, and proportional are used to describe the way the rate progresses from low to high, from high to low, or proportionally. The terms describe a distribution effect which can be applied to any type of tax system, which is income or consumption, that meets the definition. The terms can also be used to apply meaning to the taxation of selected consumptions, such as a tax on luxury goods, and the exemptions of basic necessities may be described as having progressive effects as it increases a tax burden on high-end consumption and decreases a tax burden on low-end consumption. Progressive, regressive, and proportional tax. A progressive tax is based on the taxpayer's ability to pay. It imposes a lower tax rate on low-income earners than on those with a higher income. This is usually achieved by creating tax brackets that group taxpayers by income ranges. The opposite of a progressive tax is a regressive tax, where the effective tax rate decreases as the amount to which the rate is applied increases. This effect is commonly produced where means testing is used to withdraw tax allowances or state benefits. In between progressive and regressive tax is a proportional tax, where the effective tax rate is fixed while the amount to which the rate is applied increases. Lump sum tax. A lump sum tax is a tax that is fixed amount, no matter the change in circumstances of the taxed entity. This in actuality is a regressive tax, as those with lower income must use a higher percentage of their income than those with higher income, and therefore the effect of the tax reduces as a function of income. Direct and indirect taxes. Taxes are sometimes referred to as direct taxes or indirect taxes. The meaning of these terms can vary in different contexts, which can sometimes lead to confusion. One definition states that direct taxes may be adjusted to the individual characteristics of the taxpayer, whereas indirect taxes are levied on transactions irrespective of the circumstances of buyer or seller. Income tax is direct and sale tax is indirect tax according to this definition. In U.S. constitutional law, for instance, direct taxes refer to poll taxes and property taxes, which are based on simple existence or ownership. Indirect taxes are imposed on immense rights, privileges, and activities. Thus, a tax on the sale of the property would be considered as indirect tax, whereas the tax on simply owning the property itself would be a direct tax. Fees and effectives. Government may charge user fees, tolls, or other types of assessments in exchange of particular goods, services, or use of property. These are generally not considered taxes as long as they are levied as payment for or direct benefit to the individual paying, such as tolls, a fee charged to travel via a road, bridge, tunnel, canal, motorway, or other transportation facilities. They have also been used in privately constructed transport links. The toll is likely to be a fixed charge, possibly graduated for vehicle type or for distance or long routes. User fees, such as those charged for use of parks or other government-owned facilities. Ruling fees, charged by governmental agencies to make determinations in particular situations. Inflation tax and financial repression. Some scholars refer to certain economic effects as taxes, though they are not levies imposed by governments. These include inflation tax, the economic disadvantage suffered by holders of cash and cash equivalents in one denomination of currency due to the effects of expansionary monetary policy. Financial repression. Government policies such as interest rate caps on government debt, financial regulations such as reserve requirements and capital controls, and barriers to entry in markets where the government owns or controls businesses. Income tax. Many nations has a progressive income tax system through which a higher percentage of tax revenues are collected from high-income individuals or corporations than from low-income individual earners. Taxes are applied through marginal tax rates. A variety of factors affect the marginal tax rate that a taxpayer will pay, including their filing status and the source of taxpayer's income. It's important to learn the terminology of the different income types that may affect how income is taxed. Capital gain tax. Capital gains taxes are levied and enforced at the federal level. These are taxes on the profit generated when you sell an asset that's increased in value. The rate of taxation on the profit depends on the length of time for which the asset was held. Short-term capital gains are usually taxed at the owner's ordinary income tax rate, whereas long-term gains are taxed at a lower capital gains rate, based on the rationale that lower taxes will encourage high level of capital investment. Tax records should be maintained to substantiate the length of ownership when both the assets were sold and the tax returns was filed. Payroll taxes. Payroll taxes are withheld from an employee's paycheck by an employer who remits the amount to the federal government to fund Medicare and Social Security programs. Payroll taxes and income taxes differ. Although both are withheld from an employee's paycheck and remitted to the government, payroll taxes are specifically to fund Social Security and Medicare programs. Corporate tax. Corporate taxes are paid on a company's taxable income. The steps to calculate a company's taxable income are: number 1, sales revenue minus cost of goods sold is equal to gross profit. Then gross profit minus operating expenses such as general and administrative expenses, selling and marketing, research and development expenditures, depreciations, etc. is equal to earning before interest and taxes. Earning before interest and taxes minus interest expense is equal to taxable income. Sale tax. Sales taxes are charged at the point of sale when a customer executes the payment for a good or service. The business collects the sales tax from the customer and remits the funds to the government. Each state can implement its own sales taxes, meaning they vary depending on location. There's even room for cities and counties to use their own rates, provided that they abide by the taxing rules of their state. Property tax. Property taxes are the levy that is imposed primarily upon land and buildings. In some countries, including the United States, the tax is also imposed on business and farm equipment and inventories. Sometimes the tax extends to automobiles, jewelry, and furniture, and even to such intangibles as bonds, mortgages, and shares of stock that represent claims on or ownership of tangible wealth. The amount payable is based not on a person's or a company's total net wealth, but on gross value without regard the debts. The property's assessed value is determined by the property assessor appointed by the local government. Reassessments are typically performed every 1 or 5 years. Wealth tax. A wealth tax is levied on the total value of personal assets, including bank deposits, real estate, assets in insurance and pension plans, ownership of unincorporated businesses, financial securities, and personal trusts. Typically, liabilities, primary mortgages, and other loans are deducted. Hence, it is sometimes called a net wealth tax. Tariff. A tariff is a tax imposed by one country on the goods and services imported from another country. The purpose is to encourage domestic purchases by increasing the price of goods and services imported from other countries. There are two main types of tariffs: fixed fee tariffs, which are levied as a fixed cost based on the type of item, and ad valorem tariffs, which are assessed as a percentage of the item's value. Tariffs are politically divisive. with debate over whether the policies work as intended. Inheritance tax. Inheritance tax, estate tax, and death tax or duty is the names given to various taxes that arise on the death of an individual. In United States tax law, there is a distinction between an estate tax and an inheritance tax. The former taxes the personal representatives of the deceased, while the later taxes the beneficiaries of the estate. However, this distinction does not apply in other jurisdictions. For example, if using this terminology, UK inheritance tax would be an estate tax. Expatriation tax. An expatriation tax is a tax on individuals who renounce their citizenship or residence. The tax is often imposed based on a deemed disposition of the entire individual's property. One example is the United States under the American Jobs Creation Act, where any individual who has a net worth of $2 million or an average income tax liability of $127,000 who renounces his or her citizenship and leaves the country is automatically assumed to have done so for tax avoidance reasons and is subject to a higher tax rate. Transfer tax or stamp duty. Historically, in many countries, a contract needs to have a stamp affixed to make it valid. The charge for the stamp is either a fixed amount or a percentage of the value of the transaction. In most countries, the stamp has been abolished, but stamp duty remains. Stamp duty is levied in the UK on the purchase of shares and securities, the issue of bearer instruments, and certain partnerships transactions. Stamp duty has the effect of discouraging speculative purchases of assets by decreasing liquidity. Value-added taxes. A value-added tax, also known as goods and services tax, single business tax, or turnover tax in some countries, applies the equivalent of a sales tax to every operation that creates value. For a VAT and sales tax of identical rates, the total tax paid is the same, but it is paid at differing points in the process. VAT is usually administered by requiring the company to complete a VAT return giving details. Many tax authorities have introduced automated VAT, which has increased accountability and auditability by utilizing computer systems, thereby enabling anti-cybercrime offices as well. Excise and custom duty. An excise duty is an indirect tax imposed upon goods during the process of their manufacture, production, or distribution, and is usually proportionate to their quantity or value. The fundamental conception of the term is that of a tax on articles produced or manufactured in a country. In the taxation of such articles of luxury as spirits, beer, tobacco, and cigars, it has been the practice to place a certain duty on the import of these articles that called custom duty. Excises or exemptions from them are also used to modify consumption patterns of a certain area called social engineering. For example, a high excise is used to discourage alcohol consumption relative to other goods. In the United Kingdom and many other countries, vehicle excise duty is an annual tax on vehicle ownership. Occupational taxes or license fee. Occupational taxes or license fees may be imposed on businesses or individuals engaged in certain occupations such as doctors, engineers, lawyers, property dealers, architects, farmers, etc. Many jurisdictions impose a tax on vehicle, national telecasting, etc. Poll tax or per capita tax. A poll tax, also called a per capita tax or capitation tax, is a tax that levies a set amount per individual. It is an example of the concept of fixed tax. Poll taxes are administratively cheap because they are easy to compute and collect and difficult to cheat. Economists have considered poll taxes economically efficient because people are presumed to be in fixed supply and poll taxes, therefore, do not lead to economic distortion. However, poll taxes are very unpopular because poorer people pay a higher proportion of their income than richer people. Descriptive labels or ad valorem tax. An ad valorem tax is one where the tax base is the value of a good, service, or property. Sales tax, tariffs, property taxes, Inheritance taxes and value-added taxes are different types of ad valorem tax. An ad valorem tax is typically imposed at the time of a transaction. Sales tax or value-added tax, but it may be imposed on an annual basis, property tax, or in connection with another significant event, inheritance tax or tariffs. In contrast to ad valorem tax is a per unit tax, where the tax base is the quantity of something, regardless of its price. An excise tax is an example. Consumption tax. Consumption tax refers to any tax on non-investment spendings and can be implemented by means of a sale tax, consumer value added tax, or by modifying an income tax to allow for unlimited deduction for investment or savings. Environmental tax. This includes natural resources consumption tax, greenhouse gas tax or carbon tax, sulfuric tax, and others. The stated purpose is to reduce the environmental impact by repricing. Economists describe environmental impacts as negative externalities and suggesting tax to deal with externalities. The proper implementation of environmental taxes has been the subject of a long-lasting debate. Respected viewers, you can also watch basic concepts of accounting, business law through created playlists and homemaking ideas, and many more through multiple playlists, public magazine, and subscribe the channel for upcoming shows. Bye bye till the next show.